Welcome to Max Take Profit, the channel that makes trading simple, clear, and accessible to everyone. Today we're going to break down what order blocks are, and more importantly, how to identify them easily even if you're just starting out. By the end of this video, you'll know how to spot an order block like a pro and avoid the mistakes 90% of beginners make. So stick around until the end. And if you want to level up even faster, make sure to subscribe right now. Let's start with the basics. An order block is simply a market zone created when banks and big institutions place massive orders. It's like a footprint they leave behind, and price often comes back to that zone. To make it even easier to remember, let's take an example. Imagine the price starts moving sideways in a small area. It's ranging. Then suddenly you see big candles shooting in one single direction. This move has nothing to do with an economic news release. It's simply the footprint left by large investors, banks, institutions. The area where the price was ranging before that strong move is what we call an order block. Very often the price comes back to retest this zone before continuing in the same direction, but only if certain conditions are met. How to identify an order block in 4 simple steps. Spot a strong move, institutional candles. Wait for a break of structure. Check for a fair value gap. Confirm liquidity grab. The first sign of an order block. Look for a big fast move in one direction. Most of the time, you'll see large candles forming one after another, either all going up or all going down. It's like the big players, banks and institutions, suddenly push the price strongly in one direction. Now that we've identified a strong institutional move, the next step is to confirm that this move is not just temporary noise. To do that, we wait for a break of structure. Quick side note, before we continue, we talk about a break of structure when the price breaks the previous high or low with the body of a candle. That's the clear signal that the trend has truly shifted. This shows us that the market has truly shifted direction and validates the institutional presence. Now that we've confirmed the break of structure, it's time to take it one step further. Institutions don't move the market randomly. They often leave behind a footprint called a fair value gap. Spotting this gap gives us an edge to understand where price is most likely to return. This image illustrates it perfectly. A fair value gap is the void left by the price after a fast move. It often acts like a magnet that the price comes back to test before continuing. For the fourth and final point, let's talk about liquidity. It's not a requirement to validate an order block, but its presence can significantly increase the probability of success. From my own experience, after more than 3 years of trading order blocks, I've often taken trades without a liquidity grab, this bouillac quote, and it still works effectively. Now that we've discussed liquidity, let's take a step back and look at the simplified logic behind ICT smart money concepts. This will help you understand why liquidity can be a helpful addition, but not always a necessary part of trading order blocks. According to ICT smart money logic, the market generally follows 3 steps. 1. It grabs liquidity above highs or below lows. 2. It changes structure, break of structure. 3. It returns to an order block zone before moving again. In practice, however, the market can sometimes move directly from an order block without a proper liquidity grab. That's why I consider liquidity to be a bonus, useful for reinforcing a scenario, but not essential for trading order blocks effectively. Before we move on, let's quickly recap the key confirmations you need to check before entering on an order block. The first thing to look for in an order block is a strong move, characterized by a series of impulsive candles driven by institutions. The second confirmation is the break of structure, which validates the shift and continuation of the trend. The third confirmation is the presence of a fair value gap, FVG, above the last opposing candles, just before the strong move. The fourth and final point is the liquidity grab, which occurs just before the strong move. Once all four confirmations are met, we can consider the order block, the last candle, or the last opposing candles as valid. Now that you know the step-by-step method, let's move on to the practical part to see how it applies directly on a chart. Let's use this perfect example of an order block captured on the USD/JPY 4-hour chart to understand the topic of this video in a simple way. At first glance at the beginning of our order block, we can immediately notice an impulsive move marked by institutional candles. And above, we can see that the structure has been broken, which confirms our second confirmation. After the break of structure, we can go back to the previous institutional candles to check for the presence of an FVG that could bring the price back. And yes, it is present. And just below this institutional candle that allowed the market to create the FVG, we can see that liquidity was taken before the strong move. As you can see, the price then came back to retest our order block before continuing its movement. This confirms the importance of our four validations before entering a trade. Warning: the order block strategy is not foolproof. Even if all four confirmations are met, the market can sometimes reverse or move contrary to our expectations, or may never retest the zone. It's essential to always manage your risk before entering a trade. All right, ambitious trader, now you have a clear vision to apply this strategy. Always remember, the market rewards patience and discipline. If you enjoyed this content, subscribe to Max Take Profit to keep growing and stay one step ahead of the markets. Every trade is a lesson, and every lesson brings you closer to success. See you in the next video, and don't forget to leave a comment with the next topic you'd like me to teach you.